Welcome to a weekend edition of the Trading Script, Markets in Motion. So the markets are closed, but most importantly, the weekly chart, or more specifically, the weekly candles are closed. And what does that mean? It means that based on the sum of the evidence, we can start drawing some conclusions about this market. Of course, we aren't going to pretend that we can see the future, but we are going to try to determine what is the most likely scenario to unfold based on what we can see in the charts. And what is it that we can see? Well, if we jump right into the SPY chart, we can see that the market is determined to make a new all-time high. Again, very likely into the Fed meeting. But what's next for the markets, or more importantly, what do we do about it? Well, let me tell you that based on what we can see in the charts, a pullback is very likely to unfold afterward, and yes, very likely a buying opportunity towards the end of the month. But again, we aren't fortune tellers on this channel, so once that pullback occurs, we need to see what type of pullback we get. Where does it stop? Where does it hold? However, how do we know that a pullback is likely coming? Well, for that, we need to look at some other charts because, again, there's only so much information we can get from one single chart. Let me introduce you to the HYG, or the chart for the high-yield bonds, also known as the bond market. Now, it's always been said that the smartest guys in the room are the bond traders. So it's always a good idea to see what they are up to. And what is it that we can see in this chart? To start, the bond market, at least on a relative basis to this year, has already made a new high, which means that the SPY is very likely to also make a new high. However, this is where the good news may end. Let me now introduce you to the weekly chart and, of course, the weekly moving averages. These moving averages aren't different from the ones on the daily chart, but because they represent the movement of assets over several months, they supersede the daily moving averages. For no other reason than a weekly chart, due to the magnitude of the movements, requires more money, meaning that institutional traders, or big money, is often more involved in the movements that happen on this chart. So if anything, we should have more respect for the weekly moving averages than what we have for the daily ones. And if we just look at them, we can see that the HYG is pretty much above all of them, which quite simply implies that the HYG might be entering a new weekly uptrend. And isn't that a good thing? Doesn't that mean that more happy days are ahead then? Well, not quite. Wish things were that simple. You see, first and foremost, the order of these weekly moving averages matters. For example, the 200 exponential moving average in red is a slow moving average in comparison to the 50 exponential moving average, which means that in a healthy uptrend, the 50 should always be on top of the 200. If we quickly jump into the weekly chart of the SPY, we can see that's pretty much the case. So going to the HYG chart, this isn't then a completely bullish setup, meaning that it needs either some consolidation or a pullback that, of course, being this the weekly chart, will last some weeks or even some months. Furthermore, let me introduce you yet to another technical indicator, the simple moving average. In this case, the 200 weekly moving average. Now, the difference between this and the exponential moving averages is that this one tends to be slower. So we can use either or both because in a well-structured trend, no matter the direction, these sort of overlap, not offering any new information. However, the markets still respect these slow-moving averages, especially when these belong to the weekly time frame, working as either strong support or resistance once the price reaches them. And by looking at this chart, we can see that the HYG has already reached the 200 weekly simple moving average. In other words, it has already encountered some important resistance. Of course, at the end of the day, these are all momentum indicators, so it doesn't mean that the price cannot break past through them. It only means that it will take some time to do so. And most of the time, as we can see here, it will first produce a pullback. Now, whether or not we break through this particular moving average is yet to be seen. But from a trading perspective, it only says that this wouldn't be a particularly good moment to enter the market, and that the wisest thing to do would be waiting first for a pullback, one that, since we are dealing with the weekly chart, could last a couple of weeks. Nevertheless, what happens if the HYG does break above this important moving average? Well, that would definitely be good news for the market in the coming weeks and months. But all the same, it wouldn't be a good point of entry for going long, because if we now look to a very common technical indicator, in this case, the always informative RSI, that, let's remember, here belongs to the weekly chart, we can see that we are in overbought territory, or in other words, at an extreme momentum-wise. So you see, this combination of things is at least telling us that the market needs to take a pause. And as long as both the HYG and the SPY remain above their respective moving averages, both the daily and the weekly, we can expect said pause or pullback to be a buying opportunity. But before we get too complacent, let's look once again at the VIX chart. As we said in a previous video, we need to see what the VIX does once the SPY makes a new high. If the VIX forms a new relative low, well, we can still wait for a pullback because we would be at extremes. However, this would only be a retest of the previous levels or supports, and then we could wait for either consolidation or a continuation of the uptrend in the SPY. But if instead the VIX creates a higher low and keeps the uptrend, meaning that it remains above these moving averages, well, we could expect a more severe pullback in the SPY. And when that happens, we would need to see where exactly it is that not only the SPY, but that the rest of the market, meaning the rest of the indices and stocks, find support and a change in momentum. Since let's remember, there's always a certain level of synchronization in the markets, and that could give us a clue of whether the markets will keep rallying for the rest of the year or if the overall uptrend might be coming to an end. For now, however, we cannot really say that the latter is the case, and we are only looking for some type of pullback. Of course, there's always the matter of a recession in the economy and how the market will react to that. But speculating, or rather trading the markets using fundamentals alone, has always proven to be very difficult. And if we see something more severe coming our way, we'll of course keep you posted. Thanks for watching, and don't forget to comment and subscribe as we bring you more videos regarding market and technical analysis.